FuboTV is a very popular stock on YouTube because one of the biggest financial channels talks about it a lot and recommends it a lot. So in this video, we are going to do an in-depth analysis of the company by looking at the financials, the forecast, some statistics, as well as using my Excel spreadsheet to calculate the intrinsic value of the company. So starting with a bit of an overview, this stock has really performed in the past year, being up almost 200%. However, if we zoom out a little bit, the stock is down in the past 5 years 64%. It went public in 2021, so this is a very young company. And as you can see, the market cap is only $1.2 billion. And they made $1.6 billion in revenue last year. So this is a very small company with a lot of upside potential. If we take a look at their financials, their revenue has grown a ton over the past years, although it is a bit flat from the past years. So this is a question that we need to ask ourselves. Is it going to keep back to growing revenues as it has in the past? Then, if we take a look at their profit, they are finally profitable. As you can see, because this was a very young company, they were spending the money on growth. And last quarter, they were finally profitable and they have $72 million in net income. And if we take a look at their free cash flow, it is even better. Again, it was negative the previous 5 years, but it is finally positive with $146 million. Now, one negative about this company is the numbers of shares outstanding. As you can see, they have been increasing by a lot the number of shares outstanding, which is very bad for investors because you own less of the company basically by doing nothing. So your returns will suffer from this. If we take a look at what's expected for the future of this company, analysts have been growing revenue nicely, around 9% in the upcoming years, and reach $1.8 billion in revenue. And they have them growing EPS to 14 cents per share in 3 years. So not a ton of growth, but still decent growth. And there are not a lot of analysts covering this stock because, as I said before, this is a very young and small company. Then taking a look at some statistics, the market cap, again, very small company, $1.2 billion, and the enterprise value, $1.26 billion. So this difference here is essentially the debt. If we take a look at the balance sheet, $300 million in cash and $376 million in debt. So not a lot of debt, so I'm not really worried about this. And then taking a look at some valuation ratios, the P is 16 and the price to free cash flow is 8. And the price to sales is 0.7. So very good valuation. Then in order to take a deeper look at the valuation and in order to determine future returns, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. As you can see, the intrinsic value, according to it, is between $2.90 per share to $11.22 per share, a very wide range, and the current stock price is currently trading at $3.5 per share. This also means that if my low assumptions occur, you're going to make a 7% annual return on your money, middle 21%, and high 33%. So according to my middle and high assumptions, if these assumptions occur, the returns will be insane. But again, there is a lot of uncertainty about the future of this company. So for my assumptions, I did 6% annual revenue growth rate for my low, middle 9%, and high 12%. I assumed an average profit margin and free cash flow margin of 3, 5, and 7%. This is a bit tough to do because they just turned profitable, but right now they have around 3% margin, so I think they will get better in the future. Then for P and price to free cash flow, this is a fast-growing company, so I assigned a higher PE and price to free cash flow than normal, and I went with 18, 20, and 22. Keep in mind that this is at the end of the 7 years. And then shares outstanding. I did 0%, but as we saw prior, they have been increasing this by a lot. So if we put here numbers such as 5%, which is around what they have been doing, This means that they increase the number of shares outstanding 5% every year for the next 7 years. And we go back to our 10% annual return. As you can see, the intrinsic value is much lower than before. So, as I told you before, this is very negative for investors. By the way, you can get access to a spreadsheet by sending me an email, which I will put in the description below. In conclusion, this stock is very risky, but it has a lot of upside potential. I am personally worried about the increasing number of shares outstanding, but if they stop doing that, and you believe in the products of this company, and you believe it still has a lot of growth potential, I think it's worth taking the risk. I hope you found this video valuable. Let me know what you think about FuboTV in the comments, and I'll see you in the next one.